Hey, welcome back to the Mining Pod. On today's show, we're joined by Harry Sudock, the SVP of CleanSpark, to talk all things Bitcoin mining stocks. We really dug into the value prop for a pure play Bitcoin mining stock like CleanSpark, as opposed to other Bitcoin miners out there that are really focusing on AI HPC or sort of pivoting, or the mullet miner strategy where they're kind of in between. Really put Harry on the grill for this one, going into the value prop. And I thought it was a pretty interesting podcast in just terms of understanding for my own self, why would you invest in a pure play Bitcoin miner and why invest in Bitcoin mining stocks at all. So if you are invested in these stocks or you're interested in them or interested in just learning more about the strategy for these Bitcoin miners, definitely dig into this show. Thank you to Harry for making the show possible. Also, thank you to Bitcoin Park at the Nashville Energy and Mining Summit for making this recording possible. Okay, first a word from our sponsors, and then on to the show.
Are you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com.
Today's show is brought to you by Digital Shovel. Digital Shovel is a leading manufacturer of modular mining pods as well as PDUs and switchgears. Unlike many other competitors, their product is designed and manufactured in North America with a complete UL inspection on the entire unit, not just individual components. Additionally, Digital Shovel is one of the most vertically integrated manufacturers of over 75,000 square feet of sheet metal shop, SMT and wave solder PCB assembly, as well as final assembly all under one roof in Toronto, Canada. Their price point leads the industry when compared to products with rates as low as $69,000 per megawatt for a complete data center with smart PDUs and switchgears. To learn more, visit digitalshovel.com.
Hey, welcome back to the Mining Pod. We got our last show here at the Bitcoin Park. Thank you to Rod and the Bitcoin Park team for making this possible. Harry, welcome to the show.
Thanks for having me, gentlemen.
I think this is the first time we've had you on, but you might have come on in 2021. I can't remember.
I can't remember either, so we're going to call it the first time.
That's surprising because you're one of the most prolific voices of Bitcoin mining. Well, you've been talking about Bitcoin mining for years.
He's got bigger leagues, man.
Yeah.
He's got Peter McCormick. So
No. Yeah. It's been fun. It's been fun to build a business in the industry and continue building a business in the industry, but it's also super fun to talk about the industry.
It is.
Because deep down, I'm just a gossip.
Yeah. That's actually literally what I want to talk about today. Was I was thinking about titles for the show. I was like, heterodox opinions on Bitcoin investing or Bitcoin mining investing. You and I have talked a little bit about this on the phone here and there, but I want to talk for our investor audience about how we should come to valuations on Bitcoin mining companies, and then how we look at the current landscape of people making investments. And I'm not really sure where we'll end up with this. I'm also not sure what you can and cannot say. So we will have a fun ride.
Yeah, I'm more than happy to talk about the industry. I have lots of opinions. One or two of them might even end up being right. I think that I've been, this year in particular, I've been thinking about the historical treatment of the industry because we're kind of just old enough now to be able to look over the longer arc. Mm-hmm. And I was, we were in New York. We had the great honor at CleanSpark of ringing the NASDAQ bell earlier this week.
Oh yeah, congrats on that.
Thank you. It was more emotional than I expected it to be.
Yeah.
Frankly, because I'm not great at taking any victory laps because you're fighting difficulty and halvings, and there's no days off with that. So it was really nice to have the team together and get to kind of take a moment to reflect on where we've come from, but also take that same moment to refocus on where we're going, which is really exciting. But in some of the comments that we got to make afterwards, we brought a group of investors and bankers and analysts and those kinds of folks. We brought them together and just did like a little quick hour of programming for them.
Yeah.
And one of the topics that I made sure to frame for them is that industrial Bitcoin mining, as we know it, is kind of really only maybe 8 or 9 years old at the oldest. So I really view the point of demarcation as the moment the S9 was released. Mm-hmm. That was the first kind of commercial industrial grade mining, ASIC product that was able to take you from a garage to a warehouse, from a warehouse to a container.
Yeah.
And that transition of enabling scale, for me at least, was the starting gun. And that was 2016. And if you look at the chip foundry set that was powering those chips, the S9 was also the time that the leading edge foundry products, so chips are measured in nanometers, right? And the smaller the number, the more efficient the chip. So the time that Bitcoin mining ASICs reached parity with general computing nanometer size was the S9. So previously the nanometer size was catching up. So if you had an iPhone, they were running off of a nanometer node that was smaller than maybe the S1 or the S7 or whatever the generation was. But the S9 was equivalent.
Yeah.
And so for the first time, the chip hardware matched the general computing environment broadly. And that meant that there weren't going to be these seismic difficulty leaps that you had to fight against. You could actually start to do some forward-looking financial planning, make larger investments in a mining business, and be able to predict on a difficulty-adjusted basis with some degree of certainty that you were going to get a useful life out of the rig that was not predictable during those higher nanometer sizes. So between the S9 and the S21 where we stand today, that arc of history sort of reached its maturity point for us as a sector.
Yeah.
And we're going through what I believe is a really interesting, you ever read the analyst Ben Thompson? So he runs Stratechery, which is, one of the best technology strategy platforms out there, newsletters, podcasts, and whatever, just the competition. And
we stand no chance.
And I think you do.
Ben's pretty good.
But what he talks about this concept of aggregation and disaggregation, and that industries go through aggregation phases and then disaggregation phases.
Okay.
We in Bitcoin land understand this well because of decentralization, right? So Bitcoin is fundamentally a disaggregating technology, but the mining sector actually goes through a more traditional business strategy arc of aggregation and then disaggregation. So the aggregation arc, I think, probably peaked somewhere between 2021 and 2023, and will peak again.
Yeah.
But that was when you got to this place where there were miners, not CleanSpark at the time, basically willing to buy hash rate at any price.
Yeah.
There were indiscriminate buyers, $80 a terahash, $90 a terahash, north of $100 a terahash. And they were willing to wait 9 to 12 months from Bitmain to see delivery.
Yeah.
And so if you didn't have $1 billion order, you basically couldn't get access to anything. You saw this price floor appreciation on the ASIC side that was like the ultimate moat, was this huge financial barrier.
Yeah.
Now we're seeing a really unusual type of disaggregation behavior, and this is the thesis, or one thesis that I've arrived at for our industry, which may or may not be correct. You've got a real dispersion between the portfolio approach versus the mega site approach. At CleanSpark, we're strong believers in the portfolio approach, though the mega site also works. So we see other folks in the sector, building 400, 600,000 megawatt type of deployments at a single location. That comes with, allegedly some efficiencies. We haven't seen that borne out in the data, but it certainly does come with this level of sort of single site scale.
Yeah.
But then you're also seeing a dispersion and a disaggregation of the business model. Bitcoin miners are taking their megawatt hours and they're diversifying revenue streams across them through AI HPC. We haven't done that, but I think there's certainly a huge trend of migration towards that. The $50 million pipe investment from SoftBank into Cypher,
really interesting one,
is the latest domino to fall there. I'm sure it's a really constructive deal and probably portends of more to come. And then you're seeing some interesting stuff on the vertical integration side, right?
Yeah.
We're here at Bitcoin Park for the Nashville Energy and Mining Summit. You've got the proto team here. They're working on chips. You've got the Bitdeer folks. They're working on chips. You've got the deal that Bitfarms did with Stronghold. They're trying to vertically integrate into some of the direct energy generation piece of things. And so you're starting to see everybody, disaggregate across different components of the surface area. I think that, because we've talked about the valuation process.
Yeah.
All of that complexity adds even more complexity in how do you value any of these things? What are they worth? We all know that not every exahash is created equal. Not every megawatt is created equal, and not every diversified revenue stream is created equal. So how do we put a price tag on any of these things? And so I think, for the investment community that's out there, it was hard enough trying to figure out what a Bitcoin miner is worth. Now you've got to figure out what are these other bolt-ons worth, or what, do they help you? Do they hurt you? If they help you, how much do they help you? If they hurt you, how much do they hurt you?
Yeah.
And trying to stay data-driven and quantitative in a small industry has proven to be challenging.
So on that same sort of thesis, we just had the gridless guys in, and it's also a thing that pure play miners are going to have to deal with, like CleanSpark, where you guys are competing against the global hash rate, and they're going to be able to probably compete against you guys on price point of mining at any scale, because they're, in East Africa, they're finding cheap energy, they're doing like all that sort of stuff. So there's even like another layer there where you have like the global market. So yeah, just want to like bring up that one thought. But in general, I really want to talk about like the valuation on like different things that we've talked about not while recording. And that's like, if we talk about, we'll talk about the Bitfarms deal for a second. So Bitfarms just recently sold off their $100 million site, threw it over to Hive. And the question that first popped to my mind about that deal was, why would Hive purchase this asset if they know that they're trying to get like a better valuation on their company from Wall Street money, which is going to prioritize US or North American megawatts more than South American megawatts? And conversely, why didn't Bitfarms just hold on to something if they're trying to show that they can mine Bitcoin at such a large discount to the regular market? So when you're going through like these different decisions teams have, I'm curious from your standpoint running IR, like how do you kind of pitch it to people in the banking community with these decisions? Because you can kind of make an argument for both sides,
Yeah, I think, at the end of the day, we're all running each mining company is running their own little optimization function within their walled garden. And they have limited visibility into what everybody else is doing. And they have even more limited visibility into how the investment community is evaluating those decisions, right? Yeah. So, it's complicated. The principles that we have put together is pretty dead simple, that we've built a business that sits on the intersection of four key concepts.
Yeah.
The first is energy. The second is Bitcoin. The third is operational excellence. And the fourth is capital stewardship.
Yeah.
What do those mean, right? Those are words. So energy is the thing that we procure at enormous scale on a positive sum basis in the communities where we procure it, that powers what we do.
Yep.
When we think about the cost structure of the business, as high a percentage should be energy expended as possible, because those energy dollars that get spent turn directly into Bitcoin revenue, and the relationship is incredibly tight. So, in an ideal world, we would spend 99.999% of our budget on energy because that produces revenue. Now, that's not a reality, and it's very hard to accomplish that. But if we hold that up as the ideal, trending towards that in that direction over time, it means that we have a more highly performant business. The second is Bitcoin. We work for Bitcoin. Our customer is Bitcoin. We're not signing up an HPC contract with a counterparty who wants to buy compute hours. We are selling our compute directly to the Bitcoin network, and we're paid on an algorithmic basis relative to those computations that get produced.
Yeah.
That means that what's good for Bitcoin ends up being good for us. That could mean things like the fee marketplace becoming more mature, dynamic, and interesting. That could mean things like development. And, while we don't participate in the development of the Bitcoin network as a company, we pay really close attention to what's happening there. We are Bitcoin native, and we're technology native because ultimately we're working for a technology customer, the Bitcoin network. And it also means that adoption is something that's critically important. It matters, the way that we frame that is global asset, local business. Yes, we're producing hash rate in rural Georgia, rural Tennessee, Wyoming, and elsewhere. But those local American businesses are settling transactions for wherever Eric is mining next, for Paraguay, for Argentina, for Switzerland, pick your country where a Bitcoin transaction is happening. We indiscriminately include those transactions in blocks that end up getting produced right here in America. Yeah. So we have this global touch point, even though we're building really a community business. The next one is operational excellence. And this is the one that probably gets me the most fired up to talk to with investors, which is that when you think about CleanSpark's mining operations, it's a CleanSpark site. It's CleanSpark racks. It's a CleanSpark power contract, CleanSpark employee who's touching that machine, making sure it's working properly. We think about vertical integration as what happens in between procuring the ASIC and the electron coming off of the power plant.
Yeah.
We don't spin the magnet and we don't produce the chip, but everything in between we sure as hell do.
Yeah.
So, we take that view because that's a sphere of competence that we've spent a lot of time and effort refining. And, Taylor is the gold standard in our organization for how and why we do that. Same with Brad, same with Scott. We have a deep bench of operators who bring this idea of continuous improvement and operational excellence to our mining businesses. And we're running 31 facilities at this point. So why do we have the best in class uptime? Because we really care.
Yeah.
Because we really believe that that's what delivers returns. And that takes us to the fourth kind of quadrant in this concept, which is capital stewardship, which is when we send money to Bitmain to buy an ASIC, we need to generate positive ROI on that investment.
Yeah.
When we build out a megawatt of infrastructure, that needs to perform and deliver a positive cash flow when the life cycle of utilization continues to happen. And we, it's interesting. You mentioned the gridless guys because I think they're building a phenomenal business. But if you talk to a traditional investor, they have this concept called cash on cash returns, which is, would you rather generate, and I'll use round and abstract numbers. Would you rather generate 10 Bitcoin at a 50% gross margin? Or would you rather generate 2 Bitcoin at a 90% gross margin? I'd rather generate the 10 because cash on cash returns is ultimately what matters to the investment community, what matters to us as operators. It's just the profitability on a gross basis that lets us be large and continue to get larger rather than narrowing our scope, maybe having a higher margin, more agile business, but not being able to deliver the returns that ultimately scale is able to return. We talk about scale internally all the time.
Yeah.
It really matters. It's going to matter more. And so being able to mine Bitcoin profitably at enormous scale is the game plan for us as a company.
I feel like this is your conversational, but I mean,
I got questions.
Yeah, but at the outset, you mentioned hyper mega sites versus portfolio strategy. And I think a lot of things you say here in the context, like what is different about executing operationally in a portfolio model versus a hyperscale model? Like, what does that look like?
So I want to talk about economies of scale because I think that's a really nuanced thing in our sector that hasn't been unpacked fully before. So in my opinion, economies of scale accrue to the supply chain, not the operational footprint.
Okay.
So when we sign a 60,000 unit purchase order with Bitmain like we did with a 100,000 unit option, those are not all going to one place.
Yeah.
And the value of being able to be a purchaser of that size matters on the aggregate basis, not on where those machines actually end up going.
Yeah.
They matter because we're able to purchase them at that size and then be able to build, buy, and deploy infrastructure broadly enough to support an order of that size. Same deal with the infrastructure piece. We're going to buy more transformers than we're going to ever use at one site.
Yeah.
We're going to buy more immersion infrastructure than we're going to use at any single site. So we leverage our scale on the supply chain rather than trying to leverage scale in the operating model. And I think over time, the data proves out that we've been able to achieve superior results. So we have 31 facilities. Some of our peers have 2, 3, 4. When we look at a head count per exahash, we're like less than half.
Yeah.
And the reason that we're able to do that is because we invest in technology. We invest in the engineering and design work that has to come before the first shovel ever goes in the ground. And that's not a knock on the way they're doing it. We've just made a different set of trade-offs, which is we want to be able to have an incredible amount of telemetry, visibility, and operational flexibility with how we run our facilities from a centralized location in Henderson, Nevada. And yes, of course, we have boots on the ground on site. Those are some of the finest, hardest working people I've ever had the chance to meet or work alongside. But ultimately, when we think about what it took to get us to 39 exahash, what it's going to take to go from 39 to 50 exahash, we want to be able to do that in an incredibly efficient way on the deployment side, and then continue to be able to support that hash rate over the very long term in as light a touch way as possible, while still acknowledging the reality that there's a ton of labor that goes into making those sites run.
Big players in Bitcoin mining demand stability, regulation, and trust. That's why NiceHash has moved its headquarters to Switzerland, the country known for its strong regulatory framework and for keeping its cheese locked in a safe. As one of the most regulated mining platforms in the industry, NiceHash provides institutional miners with a secure, compliant, and transparent solution to manage and maximize their mining output, delivering the reliability and performance expected from the best mining pools, along with firmware, monitoring software, and other essential mining tools. Contact a NiceHash representative today to learn why the top Bitcoin miners are making the switch to NiceHash. You can find out more info in today's show notes. And when you contact them, let them know the Mining Pod sent you.
For the capital side, I want to go into that. So capital stewardship is obviously the thing that everyone on Twitter bemoans. It's like, is it going up or is it going down? And the investors are always mad about executive compensation, or they're mad about some topic of the day. For you guys who are operating in the pure play Bitcoin mining side of things, and you guys have been very consistent over and over again, we're only mining Bitcoin, we're only mining Bitcoin. And you guys have also chosen not to do an ATM at the moment compared to a bunch of your peers, which have recently done an ATM. How do like those two things kind of fit together? To like maybe make the question a little bit more succinct, we have other groups that are kind of looking for different North Stars, and they are getting awarded for those North Stars just being in press releases, while you guys are just kind of focusing on Bitcoin mining and perhaps not being awarded for that as much. How do you guys kind of view that like long-term game?
Life is long.
Yeah.
And if you put out a press release, at least if we were to put out a press release, we firmly believe that if we say we're going to do it, we better damn well do it. And we're not going to put ourselves in a position where the headline is more valuable than delivering on the obligation. And that's a question of values more than anything. So, and I'm glad you brought up the ATM. We don't have one active. We haven't had one since the first week in November. We've been out of it, and we did the convertible raise at the end of 24. That cash was more than sufficient to power us to 50 and potentially beyond. And we believe that the ATM is an incredible product. It's why we are where we are. We've been able to raise a tremendous amount of money through it, and it may have a role to play down the road. But ultimately, we believe that we need to give our shareholders a very consistent view on what they should expect from a shares outstanding standpoint, and be able to demonstrate to them that the business can grow without needing to precipitously increase share count every step of the way. So that's what we did. We did that with a convertible structure. It's very, very clear, finite, and defined what it could mean for the outstanding share count. And then we know the type of growth that we can deliver based on the proceeds of a deal like that. And, we're gonna continue to be transparent, consistent, communicate, maybe over communicate from time to time, and just be very clear that we're great. We think we're the best, if not among the best in the world at one thing. And if we were to try to spin up a competing, business unit within the business, that focus would be diluted. The ability to dedicate every waking brain cell to the pursuit of operational excellence and capital stewardship could be diluted. And that's not to say that we're, putting our heads in the sand about AI. We evaluate it on a very regular basis. We look at it apples to apples as often as we can with the best estimates that we can. We think that our portfolio mix has maybe a couple of candidates that could be viable. But when we look sort of apples to apples on what the cash flows are, mining Bitcoin is still the highest and best use of our time, effort, energy, and capital E energy, megawatt hours that we're purchasing. So we want to stay open, flexible, and dynamic. And the funny byproduct of staying open, flexible, dynamic, data-driven, quantitative is that we get more focused over time.
Yeah. So institutional investors are people that you're pitching to help on the banking analyst side. How do they sort of take this flexible approach? Are they like pretty consistently open to it and okay with it? Or do they prefer more like the diversified opinion where we can go and dabble in all these other projects? Because a lot of like Wall Street is selling shares on behalf of other mining companies and or just like giving investment advice broadly. And they seem to kind of like throw out targets and information pretty like without a lot of consistency on these things. But whereas like you guys have been very consistent what you want to do, and some of your peers have been as well. And then some of your peers are consistent in how random they are with like their projects. So I'm just wondering from like you guys talking to a banking analyst, when you're talking to a banking analyst, how are they receiving this sort of information?
I think two things. I think, and there's some context that matters in this.
Yeah.
The first is just that public company Bitcoin mining is not old.
Yeah.
And so there's a steep learning curve that a lot of these analysts have had to climb. To their credit, they're very, very sharp and they've climbed it well.
Yeah.
I think that the ability to project, you're asking them to do the impossible. You're asking the analyst community to be right about two things at the same time.
Yeah.
One of them is the price of Bitcoin over time. The other is the degree of difficulty on the network at any given time.
Mm-hmm.
And as somebody who's tried to model both of those things, I have always been wrong. And so you're asking them to do the impossible, and that's really tricky. So I think the sophistication of analyst work has been honestly more impressive than I anticipated.
Yeah.
And secondarily, they have a really healthy appreciation for the sector and the business.
Yeah.
I think that what's so interesting is that this AI HPC thing is kind of even more new than Bitcoin mining. And so we're all climbing the learning curve on that piece at the same time as well. And let's use our friends at Core Scientific as sort of the poster child for this.
Yeah.
You know exactly what their cash flow profile is going to look like based on that contract for like 12 years.
Yep. Yeah.
That's an analyst's dream.
Yeah.
Single counterparty, highly capitalized, 12-year contract. You can net present value that thing all day long.
Yeah.
And so if I were them, I think that's a much more digestible and valuable, not valuable, but valuable type of business to do the spreadsheet crunching on. I think that they have an appreciation for optionality. I think optionality is a valuable thing so long as the options are priced and digested on an apples to apples basis well. But I think also, there's commentary and feedback that we get that we bring an enormous degree of professionalism to our industry, but to the market on a general basis.
Yeah.
They appreciate our willingness to participate in dialogue. Our willingness to take feedback from them because we don't know what we don't know, and it's an evolving landscape that they bring a lot of insight to transparently. And I think it comes down to this more fundamental question, which is what's an exahash worth and what's a megawatt worth and what's a CleanSpark exahash worth and what's a CleanSpark megawatt worth.
Yeah.
And that's just a tricky question that takes time. It's a bit trite, but what Bezos would tell you is, in the short run, the market's a voting machine. In the long run, the market's a weighing machine. And we're probably still in voting machine territory if I'm truly honest.
Yeah. So it's interesting you're saying that you like where the analysts are at and you think they're further ahead, because Twitter would disagree. And then some of my favorite mining analysts out there would also be like bemoan it. So like we had Penny Ether on 2 months ago and he had a great show and he was just kind of taking them to task. So I'm curious, like, where's the breakdown there? Do you think that there's held an unfair standard, or do you think like there's any? I certainly think on my side, I won't hold you to this. I think there's some bank analysts out there that are just obviously trying to sell their shares and like.
Yeah, I mean, look, you show me the incentive, I'll show you the outcome.
Yeah.
So I think there's probably some of that, but ultimately, like, Bitcoin's about personal responsibility, and I think that so is investing. There's a personal responsibility that comes with these things where if you disagree, and we've seen it, right? Like and I'm not comparing the banking analyst community to the mainstream media by any stretch, but you've seen higher quality information get disseminated on X or on Nostr than you've seen on CNN or Fox or CNBC. Yep. And I think you've seen some really insightful, sharp analyst commentary come out on Twitter that is also occasionally ahead of the traditional analyst community. And that it means that there's the beauty of being a public company is that there is disclosure, transparency, and it opens the door for analysis and scrutiny in a way that I think is tremendously constructive. I think that, the American economy is healthiest when companies go public, because it's an opportunity for the public to digest their internal data on a routine basis. That's really healthy. Yeah. And the more people who are poring over those disclosures and surfacing insights makes for a more, I don't want to say fairly priced, but a more insightfully priced securities market. Yeah. So, so I think those are themes and trend, and then not to mention, bringing, Bitcoin's on-chain transparency into the mix, which is its own sort of radical transparency layer that you can include beyond, what I just said. So I think that there are still rungs on the learning curve to climb for both the, individually contributing analyst as well as the banking analyst. But ultimately, the market sets the truth point, and what the next share clears for today is the true price of the asset. It's our job as a management team to continue to educate the public, provide more comprehensive and quality data to the market, and to have conversations like this so that, folks on the other side of the screen or the phone can begin to understand how we think about the world and the types of information that gets fed into the decision-making processes that we're running on a regular basis.
In the competitive world of Bitcoin mining, one name stands out: CleanSpark, America's Bitcoin miner. At CleanSpark, efficiency isn't just a goal, it's our standard. Our sophisticated facilities are built and led by expert teams who care about Bitcoin and the communities we work in. Scale? We've mastered it. Our large-scale operations have set us apart in the industry as examples of community-oriented building. Our track record speaks for itself. We navigate the complexities of the new economy with precision and with skill, continuously achieving operational milestones. Curious about how we do it? We invite you to discover the story behind CleanSpark's success at cleanspark.com.
I don't know if this is a layup or a hot seat question, but you used language at the beginning. You say you take transactions everywhere in the world, bundle them up into a block made in the USA. Language our now president has used. But we're talking about producing a nonce, which is the hash of the block template, which is produced in the USA. But what does your right side of the curve take on this idea of producing Bitcoin in the USA? How should public companies think about talking about this?
I hate the word should.
Yeah.
I'll tell you how I think about it.
This is the right side of the curve then.
Yeah. I think that the economics 101 answer is actually pretty compelling, which is the reason that Bitcoin mining is the reason that proof of work plus the difficulty adjustment is so meaningful to the Bitcoin network is because it credibly solves the fair market hypothesis that Milton Friedman would have written about 70 years ago, where the reason, you know, the freedom of association to do business, the barrier to entry to enter the business as a new entrant. And I think that we get sort of we Bitcoinerize this conversation to our detriment sometimes, which is mining has gotten so big. Don't I need a lot of money? Isn't that a barrier to entry? That's not a barrier to entry. Getting a license to do a trade, that's a barrier to entry. Needing to be credentialed or needing regulatory approval, those are the types of market forces, or I should say market distortions, that create for a lower quality marketplace and a more price distorted marketplace. Needing a lot of capital to compete is not a barrier to entry. It is a market reality. And that's where, if we're going to really go deep onto the right side of the curve, I think that Bitcoin mining is one of the most incredible, credibly free and fair market opportunities. I don't need to take anyone to a steak dinner to earn my block fee. I don't need to take and I'm not selling software.
Yeah.
I'm not, there's no bias associated with if my terahash second is more valuable than yours.
Yeah.
And so that level playing field creates an opportunity for the fittest of companies to win. And that's why it's so exciting. And that's why the objective to make Bitcoin in America or process transactions in America is such a motivating force for me, is because really what that call to action says is that I want the fittest mining companies to be built, scaled, refined, and delivered right here.
Yeah.
What that doesn't mean is I want to create an artificial regulatory moat to force the Bitcoin miners to work here. No, what that says is that we have capital markets and energy systems that are sufficiently sophisticated, large, and powerful to power the fittest companies in the world to grow and scale here. That's what it means to me, and that's why it's motivating, and that's why I view it as an aspirational call to action, not a threat of a regulatory barrier.
Get your answer?
Yeah, that's the best answer I've ever heard.
Okay, I'm going to pivot back to capital markets. That's where my mind is stuck. Yesterday, Vanguard put out 2 notices. They purchased 6% stake in Coors and a 6% stake in Applied Digital. We also had DCG's Grayscale announce a new product. I think it's the Miners is the ticker.
Stop putting Z's in tickers.
I know, I really got to stop it. But anyways, we are seeing these new financial products in order to get exposure to Bitcoin mining. Curious what you think about them. Do you think they're going to grow the moat for Bitcoin miners? Why not just buy a basket already? Do people just have they don't want to investigate which ones to buy, so they're just going to buy an ETF product?
Two pieces. One is and this applies to Vanguard, BlackRock, TD, and others.
And the Vanguard one, I don't know if it's an ETF yet. I'm assuming they might be purchasing to roll that into something, or maybe
it's not really how they work. Typically, if you see Vanguard is not taking balance sheet risk on Applied and Core.
Yeah, so I thought they'd be doing an ETF on behalf of others with those shares. But
they also have a brokerage business, so it may be somebody who in their Vanguard account is owning a single name stock. For all we know, it's some high net worth individual who's taking a single position, but they're doing so through their broker, who is then obligated to disclose when they reach above a certain percentage ownership, beneficial ownership limit. So I think that the direct attribution to Vanguard as the owner. So if you looked at our top 5 shareholders, you're going to see all of those same big players, because
BlackRock's taking over Bitcoin now.
Yeah, BlackRock doesn't own these securities. Customers of BlackRock own these securities through an omnibus structure that ends up reporting on a single line item, even though there maybe are tens or hundreds of thousands of individual shareholders associated with that single position. So, I would dispel that one piece of it probably right away at the outset. The Grayscale ETF or ETP or whatever, I've run out of acronyms this year. That's more interesting, and they've released a methodology. I think they, we'll see. It basically, it's just like the same type of structure as WGMI.
Yep.
Which is we have a portfolio manager who's developed a weighting methodology. We are going to go get exposure based on that weighting methodology, and then the same way that if you bought a share of the IBIT or BitB or the ARC Bitcoin product, they go, you give them $10, they go buy $10 worth of Bitcoin, and you get the beneficial ownership of shares in that product. So I think to me there, the way that I would look at it is, what AUM does that ETF have inside of it? And then based on the weightings that have been disclosed, how much ownership does that associate with in the public companies that they've taken a stake in? WGMI is like pretty small.
Yeah.
Relative to the aggregate market cap of miners. So now if we saw $25 billion flow into these types of ETFs, then I think that the structure starts to play a bigger role in our industry, and we want to be able to influence how much weighting we receive by giving additional information to the market and making the case as to why we're a great position to include in a methodology like that. But on the face, it's easier to click one button than 10 buttons. Yeah. And so there's sort of that very base left curve kind of friction associated with it. The other is that my guess is, and I have no basis for this, but this is just a full opinion, that if you're a registered investment advisor and you have clients banging down your door saying, hey, I want to own the miners, you as the RIA don't want to take responsibility for how much of A versus B versus CLSK you'll take a position in. It's much easier if you are able to offload that decision-making responsibility to a third-party portfolio manager who decides how much those weightings should be aligned with. And so I think that, the most bullish view on the release of a product like this is that it means that there's a tremendous amount of RIA demand who don't want to take individual weighting positions, but do want to get their clients exposure on somebody else's research back.
Second question to pair with that one. So there's been a lot of podcast hours spent on the idea of MicroStrategy versus the Bitcoin miners, and which one should you purchase? I like to think with the new Trump administration that we're going to see a bunch of new listings for crypto equities. Exodus Wallet got listed, I think, in December. I don't know.
Fold is about to be.
Fold just did their SPAC. Like, I'm assuming there's going to be more. I don't know about miners. Miners had like their moment 21, 22. Seems like there's competition coming. How do you guys position yourselves to be interesting to Wall Street when there's all these other nice crypto equities out there that are going to possibly pop up?
I'm going to give you my deep left curve view. Yeah. I always try to frame where I am on the curve and spend no time in the middle. We mine Bitcoin for a profit. We produce Bitcoin below spot. So if you look at our energy spend per coin from our previous quarter, it was, I think, $36,250 in energy per coin. Bitcoin was worth on average, I don't know, 80, 90 something thousand during that same period.
Yeah.
Or probably lower because it was a quarter back, but whatever, much higher number.
Yep.
And the difference between there is called gross profit. We did our convertible bond offering in mid-December. We didn't use the proceeds to go buy Bitcoin. We used the proceeds to expand our mining business because we could buy Bitcoin for 100K or we could mine it for 36K.
Yeah.
And mining is sort of one of the last places in the world where you're able to produce Bitcoin for a dramatic discount to spot pricing.
Yep.
And so the value proposition that we offer as a miner, though maybe not all of them do, is we're able to deliver those types of unit economics over a very long-term basis. And we have the added benefit of retaining some or all of that production on our balance sheet over time. So we have 10,000 and change Bitcoin held on balance sheet. We mined all of them.
Yeah.
We didn't buy any of them because, we believe that if we use operational excellence and capital stewardship, the Bitcoin on our balance sheet should be acquired in a very positive cash flow type of way.
Yeah.
So, why why buy MicroStrategies versus miner X? If the miner is a good miner, they're able to produce Bitcoin below market. MicroStrategies is basically selling, $2 of equity for $1 of NAV value present time to go acquire more Bitcoin and continue to sustain that type of premium. That's just a different thing.
Yeah. It's a different game entirely.
Yeah.
Yeah. But okay, one follow-up question. This might be a smooth brain question, so you don't have to deal with me on it. When we're talking about like the premium there, it's probably what you care about. Like, you don't want to just be like, you could just be priced for what the company is valued, and that's great. But like a premium enables you guys to go do a bunch of things with capital, right? So everyone wants a premium on their business, and that's kind of what MicroStrategy keeps pushing for, is like getting that premium. For you guys, in a world where there's more competition, there's other miners with different playbooks, there's other miners with the same playbook, how do you guys continue to push up that premium? Do you think it will just be as simple as that messaging?
Operational excellence and capital stewardship.
Yeah.
If we get those two things right, which we have, then the rest of it is up to the market to decide what that's worth. But our job is to take our view of the world and express that view through business performance over time. We have our view of the world. We think energy is a critical input. We think Bitcoin is a critical output. We want to use that input to deliver that output on as high a margin basis as possible over time, and then take the lessons, the hard-won lessons over time, to refine and improve that business systematically and continuously. And if we do that for long enough, we think that the market will come to understand that we're a different type of miner.
I got one more question for you. And maybe if you have one more. So I saw this playbook work out with CleanSpark 21 to 22 to 23, where I had Zach on the podcast in the bear market. I think hash price, it hit lower during that cycle, but it was the beginning of the drop off. It was maybe a few months after FTX. And Zach and I sat in a basement in Jackson Hole. We didn't even have a camera. It was just
sounds like the bear market.
It was pretty pathetic, but it was kind of funny at the moment. And we talked about like this playbook and very similar mantra that we're talking about now. And in 23, you guys were like the darling of the market for sure. Like CleanSpark, which was cleaning up. Just the share price appreciation was wild. 24, it just seemed like there was like a smattering of everyone. Just a lot of people rose up. Core Scientific was probably the stock of that year. What do you think's in store for 2025? Like, where do you see the narrative going for mining stocks for all these various companies? And
well, voting machine, weighing machine, which we talked about. I think the question is, do we think it's a voting machine this year or not?
Yeah.
The great news is that we're going to continue to deliver the operating business that we committed to delivering and have delivered over the years. And, life is incredibly long, and we're not running out of Bitcoin subsidy anytime soon. And so I think that continuing to stay long-term oriented is critical to the way that we've run the business to date. It's going to be critical as we look to the future. I think that there's a fundamental physics to business, which is you make an investment, you produce revenue, that revenue takes costs, and you're left with something at the end if you do it well.
Yeah.
Nothing about narrative or like those types of sort of more ephemeral ideas will carry the day as long as you look out over a long enough time horizon.
Yeah.
I think there's market structural components that rear their head, from time to time, whether it's new institutional entrants or whatever the case may be. There's always a market structure piece that sits underneath at sort of the micro level. I'll never forget, your audience will have to forgive me, but I was an economics major, so these things come to me when I don't expect it. But I had
invisible hand, if you will.
Yeah, I had a professor who said, he doesn't believe in macroeconomics.
Yeah.
He just believes in the aggregation of a really big microeconomics.
Yeah.
And so
I dig that.
Right?
I dig that.
Right. He's like, macro is not real. It's just the sum of a lot of micro.
Yeah.
And I don't know if I all the way believe him, but I believe him enough to quote him.
Yeah.
And I think that, that's kind of how we think about the business is like, we're going to plug in another megawatt. We're going to plug in another single S21 immersion.
Yeah.
And the sum of each of those parts gets us to where we're supposed to go over a long period of time, as long as we continue to operate with integrity, continue to be transparent with the market around us, and continue to do the next right thing. How do you eat an elephant? One bite at a time.
Anything from me, Charlie?
Maybe to wrap it off, I'm not as deep in the financial markets and equities as you guys are, but
good.
Yeah. So I might be revealing my hand here, but it's going up forever, Laura. Hash rate will increase. The game is expansion. But do we ever transition maybe to a dividend model if we're looking at public equities? Like, does this ever happen?
I think it could totally happen. I think that there's it's a complicated question.
For my closing question, you explain.
I don't think it's a bad question at all. I think that it's one that I'm not in a position to comment on us whatsoever, but I think that over time different industries have taken different approaches to dividends as a concept.
Yeah.
If you look at like Apple, right? I try to learn from companies that have gotten, way bigger than us and look to what they did really well and what are some of the other lessons that they learned the hard way, and can I learn it, in a less hard but still hard way. They offer sort of a very nominal sub 1% dividend that I think, is interesting because it makes them a dividend payer, but it doesn't do so with the vast majority of their net profit.
Yeah.
And so I think it's interesting to just spend the time learning about what a lot of other people have done in a lot of different industries. And until I feel like I more deeply understand what they've done and why they did it, I think that, then I may have a more helpful opinion. The other piece of, dividends that's really interesting is that, the way that the American tax code is developed right now, dividends are basically disincentivized. So shareholders get ordinary income tax associated with their dividends.
Oh, that's lame.
If we were to buy back shares, which we just did as part of our convertible structure, you're basically able to deliver the same impact to shareholders without creating the taxable event for them. And so I think that's why you've seen such a huge boom in the buyback trend broadly over the last 10 or 15 years, is that people realize that dividends are tax expensive and buybacks are tax cheap. And so you saw migration towards them over time, that maybe that's the highest and best use of the cash coming out of their business operations. So I think it's a complicated and deep question. I'm really proud of the fact that we did a buyback associated with our convertible raise. And I think that's sort of the, one of the steps for us as a company heading down the road of capital maturity. But it's a topic that I won't forget the question, and we'll continue.
We'll have to come back in a decade.
Hopefully less than a decade.
Yeah. Things happen really quickly.
I miss you guys.
Yeah. No, that's great. There's like 10, 20 other questions I want to get to, but we'll wrap up there. Thank you so much for joining, Harry.
Gentlemen, always a pleasure. Thanks for all you do.